Limits on the number of people who can apply and their income have been scrapped, and the government has raised the property price cap above the national median. That means in Sydney, the most expensive market in the country, first home buyers can access this scheme for a property valued at up to $1.5 million. In Brisbane, the Gold Coast and Canberra, it's up to $1 million. In Melbourne and Geelong, it's up to $950,000. Now for the repayments, taking the most extreme example for a $1.5 million property in Sydney, on the average variable interest rate of 5.5% over 30 years. So your monthly repayment would be around $8,000 a month. This scheme also doesn't account for stamp duty, which for that Sydney property would be around $64,000.
Probably most first home buyers will be able to look into this or may be able to benefit from it. So the government expects that about 80,000 first home buyers per year could benefit from this scheme. And that's out of a total of maybe about 110 or 120,000 in total. That's a sort of normal number per year in Australia. So it's the majority of first home buyers, I think we're expecting, will be benefiting from this scheme in future.
Okay, and how do people apply for it?
They probably are going to access it through the bank or their mortgage advisor who is assisting them with getting their loan. They're still going to have to get a mortgage. In fact, they're going to have to get a larger mortgage if they are going to get help with this through this first home guarantee, because it's enabling you to get a mortgage with a deposit as low as 5% of the property value, compared to the usual 20%. But that does come, the quid pro quo for that is that you're taking out a mortgage for 95% of the value of the property, not 80. So you're going to be arranging a mortgage anyway, and you're going to be making an application for this scheme as part of that process.
How can people use their super for a house deposit?
Well, only up to a point. I think that's probably not something that would normally be allowed. I think the banks may also expect to see some evidence of savings behaviour or savings habit from applicants. I think if you come forward with you offer a 5% deposit, which all comes from a parental gift, or even if you're allowed to access your super from that kind of source, and you weren't able to show the evidence of a savings practice, you might not be accepted for the mortgage.
And do people have to live in the property once they've bought it, or can they rent it out?
No, they do have to live in the property. This is not very targeted in terms of the there's no income limit. People on any income who are first home buyers can apply. There's property price limits which are not very restrictive, but there is a restriction. It is targeted in the sense that it's not for it's not for people who are buying a property to rent it out to somebody else, to be a landlord.
And what happens if I default on the repayments?
Well, I don't think it would be any different to a default situation, that might occur, that does occur to a very small proportion of borrowers every year. Your home could still be repossessed, ultimately. So it doesn't really change that.
But there's no lender's mortgage insurance attached to this. Somebody who's uses the scheme doesn't have to pay that, do they? With such
exactly.
a deposit?
So we normally talk about a standard requirement for a 20% deposit. That's a typical what a mortgage provider, a bank, other mortgage provider. That's typically what they require to issue the mortgage in the first place. What we're seeing here is that it would be a lower amount that you'd be expected to put forward. But that's the benefit that you're getting from the scheme.
So who would benefit? What would be the circumstances of the person who would benefit most from this scheme, and what would be the circumstances where people should really think twice about it?
Well, people on moderate to high incomes who are easily able to afford the repayments on a mortgage of the kind of size that they're going to need, but they've only just started saving because perhaps they've just entered the job market, or they've had other obligations up until now, or they've been spending their money on other pursuits. So they're hoping that they can access home ownership as fast as possible, and not have to spend maybe 4 or 5 years saving the 20% deposit. And the mortgage insurance issue that you raised just now is what that's about is that we talk about the standard 20% that banks normally expect under that's the traditional level, but it is possible to get a mortgage for at least moderate to high income earners, even if you can't put forward as much deposit as that, now, or in the past that has been possible. But the cost is that you have to pay an additional amount in lender's mortgage insurance, or LMI. And what this first home guarantee enables you to do is to still take out that mortgage at a much lower deposit rate, maybe 5%, but you're not paying the mortgage lender insurance.
And if you're on a lower income, you should really do the sums.
Well, if you're on a lower income, this is less likely to be something that helps you. Some of the other schemes that the government has been developing, in particular, the shared equity scheme, which is just coming in, which will come into force, I think, later this year or maybe beginning of next. That is much more targeted towards people who are on a low to moderate income, and that is something which will be useful in perhaps enabling a few people up to 10,000 per year to get into home ownership, even though they're on much or significantly lower incomes.
And finally, and it's a big question, Hal, are you always better off buying a place than renting one?
I wouldn't say always, but I think in the current housing market in Australia, and the one that we've been familiar with for many years, it's usually the case. I think you need to have confidence that you're able to hang on to the property, that that you'll be able to avoid having to resell anytime soon. If you've got a horizon for hanging on to ownership at least 5 years, then it's likely to be beneficial to you.
Hal Pawson, thank you for the advice. Good to talk to you.
Thanks.